This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Taylor from Life Goal Investments. How you doing, buddy?
What's happening? I missed you for a couple of weeks. I'm glad we're back in the saddle. Here we go.
Yeah, it's really fun. So first and foremost, I had 8 amazing days in New York. Saw my daughter, had great food, saw family, friends. It was amazing. But yeah, I miss talking to you. It's always fun talking to friends.
Let's do it. Let's catch up.
Well, I think the first thing we have to talk about is Friday, right? We got a very strong jobs number from memory. Expectations for 200. We came in at 263. That was interesting. I actually think more concerning, as the economist in the room, was wages, right? Wages went up. I think it was from 4.6 to now 5.2. Yearly, month on month was expectation 3, came in at 0.6. I've been talking about wage inflation. I've been talking about it being the hard part of like the very hard part. Friday did not make me feel good. And then the market tanks pre-market at the open. And by the end of the day, it's up. You're a 10-year Wall Street vet. I'm guessing you saw this coming, right? And you're like, no problem. And
No,
what happened Friday?
No, I didn't. Friday's market was a reversal that I did not expect. And to all the points that you stated there, I mean, job number comes in awfully hot. Hourly earnings come in awfully hot. So you look at this report and you go, okay, that's good news. And these days, good news is bad news.
Bad news.
Because again, obviously that says that the Fed might not have inflation under control. They're going to have to jack up rates, yada, yada. So that was my expectations. And I expected the market to get hammered pretty darn good on Friday from both a stock market perspective and a bond market perspective. And so
the bond market was really surprised. So the bond market, again, I was up early when it came out. I think it came out at 5:30. I was up, or at least Pacific. And the bond market immediately went up like a tenth. And then by the end of the day, it was down. We were under 3.5 on the 10-year. I'm like, I don't understand what's going on. What the hell?
So I don't know that I have the perfect answer to this, but I do have what I think is
that actually makes me feel better.
Oh, no, listen, day to day, week to week, man, no one can necessarily make sense of all these gyrations in the market. And that's, don't let anyone tell you any different on that front. But what I think potentially happened on Friday was the market came out and said, okay, good news is bad news, and therefore the Fed may have to raise rates. And so therefore the market sold off in a really meaningful way. And then I think what happened was that the narrative kind of shifted in the market's mind and said, okay, you know what though? At this point, we might be fearing recession more than we're fearing the Fed, right? So yes, the Fed could potentially lead us into a recession, but we know higher rates are coming. And maybe this jobs number, the unemployment number, which came in real low, the labor number, the hourly earnings numbers that came in hot, maybe this says that there isn't this absolute imminent recession coming. And maybe that's actually the positive that we needed to see. So it went from saying good news is bad news because the Fed's going to have to raise rates to, yes, they're going to continue to raise rates, but yes, this economy still continues to chug along here. And because of that, maybe we're able to fight off a recession in the long run. Now, that's up for debate. And you and I both agree on this, that we don't necessarily think that that's the case. But I think that's the narrative shift that took place there. And I can't make any other sense of why the market rallied, knowing that this makes the job of the Fed much harder. There's no disputing that.
Yeah. So again, I agree with you. The one place I got over the weekend, knowing you and I were talking, so I didn't get there. I love the way that you put that. That makes sense to me. I did not get there. The place that I got to was back to this general understanding that labor is always the last thing to fall. That's the other thing I thought the market might be saying is, again, they go back and look at CPI, good, PPI, good, PCE, okay, jobs is the last thing to go. That was where I thought maybe the market got to, but I think I like your story better.
Fair assessment. No, yeah, but fair assessment, because again, we've been preaching this, and that's why it's sometimes tough that the Fed looks at lagging indicators, right? They look at inflation, that's a lagging indicator. They look at unemployment, that's a lagging indicator. So that's why Jay Powell and the central bank has to be so careful, because they know this too. They're not stupid. They know this, and they have said more recently that we need to be cautious about what we've done in the past not having taken hold yet, and we don't know where it's going.
That's actually funny you bring that up, because when I compare the Fed statements or interviews or whatever you want to call it, a month ago, Powell was basically saying, we're going to go higher, we're going to break shit, and then we're going to fix it by cutting rates. That was a month ago. Last week, he actually admitted, we're going to slow down because we really don't want to break stuff if we don't have to. That I saw that difference. Did you catch that?
Yes, but I do. What's also interesting is that I've also caught now the inclination, and I think there are words that literally have led me to this, and maybe you can put them in my mouth. Is that he is now basically saying that a recession is kind of the base case for the Fed at this point.
Yeah, I've actually studied economy for a long time. I actually think 2023 is going to be like the 1969 recession, and I'm not expecting you to know what that one was like. It was 11 months in duration, so a little bit lower than the average recession as far as duration, but it was one of the most shallow recessions ever. From memory, I think it was only a negative 0.9% GDP.
Gotcha.
Right. So I think a lot of people hear recession, believe a recession is coming, but they all think it's going to be a deep, dark, nasty 3.5, 4.5 cumulative. I just don't see it's coming. Because again, I think what we're seeing is a relatively strong job market. It's going to get softer, no question. Unemployment's going to go up. But I think we're going to have a 12 to 16 month shallow recession. And I think in the history books, it will be called a soft landing or a soft-ish landing. I just don't see how you don't have some kind of recession.
I agree. And I've kind of, I thought we would get to recession sooner, but over the course of the time that we've chatted, I've said we're going to go into recession, but I think it's going to be shallower. And I thought it would come sooner than it has, admittedly.
Mm-hmm.
So I think what you're going to see here is, I don't know that it's necessarily a foregone conclusion, one, that we go into recession, and then two, how bad is the recession? Because I think we're at a position right now where you look at the economy as a whole and you look at inflation as a whole and you say, okay, is this 1970s inflation where it lasts and persists for an absolute decade that's absolutely brutal? I don't think that's the case, but I don't think it can absolutely full stop be ruled out. So I actually think that the peak of inflation is behind us right now. But
so I think peak of inflation is behind us. We agree. I actually want to give you this. I think inflation is a stack. And I think there are three blocks on the stack. I don't know how else to. So there's the top of the stack. We'll call it a yellow brick. I'm thinking Legos at the moment. I don't know why, but I am. So the yellow brick is easy inflation. It's stuff. It's lumber. It's clothing. It's TVs. It's computers. That stuff is coming down quickly. We have inventory growing. This is Kathy Wood's deflation.
Right.
I think that is easy, and I think that blows off by March or April. Done.
Supply chain has really helped that. COVID exacerbated that. China too, but Russia, Ukraine exacerbated that. That's kind of, for the most part, behind us.
And it's going to bowl off. I think we're going to go from 9.1 peak. I'm going to call it 6 just for easy math.
Sure.
Then there's the next block. That's a green block. It's hard, and it's housing, rent, price, sticky, backward looking. And easy comes off by March, hard October. Then this is the problem, the really hard. And that's a red block. It's structural, it's deglobalization, it's wage inflation spiral. I think that stuff's 3, 4, 5. I think we are uncomfortably stuck, anchored magnet at 4% for years. What do you think of that stack?
Yeah, it's an interesting way of thinking about things, and I think you're right. I think I think and you have a better beat on this than me, so maybe I shouldn't talk against you on this, but I think the housing is more gone than maybe what your estimate has put there. I think it's going to abate faster. I think that the housing market is taking on the absolute chin. Here's an interesting stat I actually read out of Barron's on the weekend, that the median home in the United States, the monthly payment, and you might know this, to prior to COVID compared to right now is 70% higher than it was pre-COVID. That can break stuff in its own right. That should cause a massive rollover that we're seeing. And again, we're supply constrained, so therefore housing's not going to fall off a map by any stretch, but the affordability is just absolutely plummeting. And so therefore, I think that you get a rollover in that. And that, I think, is something that we're working through right now. So I would say that one's going to abate quicker, but you're right. When it comes to the labor component of it, it is absolutely sticky. And one thing that's interesting when you think about investing and you think about the stock markets, you think about the stock market in the S&P 500, that is more of the goods than it is the services, right? So
Agreed.
70%
Agreed.
of that S&P 500 earnings is driven by goods. Yet our economy is the exact inverse of that, literally the corollary to that.
It is.
And the fact that it's 30% goods, 70% services. And the services are that component that you're speaking of that's really tough for us to chew through. And I think it's important to draw the line of bifurcation between what is our economy, which is 70% services, 30% goods, and what is the stock market, which is 30% services, 70% goods. So the economy and the stock market are two different things here.
Yeah. And the other thing, obviously, is the stock market often is called a leading indicator, right? It's looking
Correct.
6 months out. And I want to call bullshit on that for a minute, because I don't think Wall Street, again, is done what it's supposed to do and taken earnings down. I think the average earnings for the S&P is still like 236 or 238. Dude, as an outsider, I'm like, dude, this got to be closer to 200. What the hell are you guys smoking?
Yeah, it's interesting. You've seen just a perpetual drift. We've been talking about this all year, literally. You and I have been talking about this all year. Like, we're not seeing
What's
it.
going on?
And I think that maybe, and I don't want to put words in your mouth, but I will put them in my own and say, maybe my forecast was that they were going to have to come down further and faster. And Wall Street analysts have said, no, they're going to keep where they are and actually have increased them a little bit until recently. And I think kind of somewhere between those two. So Wall Street analysts have definitely been coming in our direction, not with the speed and ferocity maybe you and I had both expected.
They got
but
their Q4
nonetheless,
bonuses
they're
coming
down.
up, so they're going to wait till next year.
And let's call a spade here. And I'll say this, and you already know this, but I come from the Wall Street side, having seen and worked with analysts in the past. There are absolutely relationships between analysts, CEOs, CFOs, et cetera, that they cover. So they don't want to have a big blaring black eye on their buddy that's the CEO, CFO of that company. That doesn't look good for their career.
Yeah. So at the end of the day, and then again, I want to go back to the bond market. Can you believe on Friday, the 10-year note got under 3.5? I think it's up a little bit today. I mean, we were just, what did it peak out at, like 4.6 or something?
Yeah, somewhere in that ballpark. So what's interesting right now is not just where the rates are, is that the rate of inversion. So again, this is wonky, but I'll just suffice it to say right at the beginning, the bigger the inversion, between, meaning how much higher is the 10-year yield, how much higher is the 2-year yield, the short end of the curve, than the long end of the curve. In a normal market, you have 2 years and inside, 1 year, 2-year paper yield significantly less than 10, 15, 20, 30-year paper, logically, because you're not locking it up forever. But right now, you actually have an inversion between 2s and 10s, where the 2-year yields 72.72% more than a 10-year paper, which makes
the funds
zero
rate.
sense.
The funds rate is 3 3/4. The 10-year note was 3.5. Dude, that's overnight paper, or that's not even paper. That's overnight rates.
T-bills, you're exactly right. And so what this has precluded historically, in a very, very high probability, is a recession. And what's interesting, so Michael, here's a really interesting thing. I know that we've discussed you buying short-term paper and saying, hey, I'm just going to hold on to 2-year, 1-year, bills, bonds, whatever.
1 year looks great.
So historically, what you actually have is, in an inverted yield curve, you actually have better performance out of the long end of the curve, which makes no sense. So let me just draw out
because you get when it comes back, you get the
what happens is what that tells you when the yield curve is inverted is that the Fed is going to have to cut rates to stave off a recession to come. So if that's to happen, what happens in 2-year paper is, in 2 years, it resets lower.
Correct.
But that 10 years stays fixed at, call it 3.5 versus 4%, just using round numbers right now, 4% on a 2-year. But in 2 years, that 4% on a 2-year could be 3%. And then 2 years from there, it could be 2%. But that 10-year paper is fixed there at 3.5%. Even though it's lower, it actually has historically, in an inverted yield curve, the long end of the curve has produced better returns than the short.
Total return.
Very contrary to natural thought.
Yeah. Yeah. When you're looking at total return, you're absolutely right, which a lot of people should be looking at. Absolutely. So it's funny. We're going to talk about a Fed pivot video number 2, but you put out some amazing stuff on Instagram. Where should people follow you?
Yeah, thanks so much for letting us give a plug here. We're at Life Goal Investments on Instagram. What we're trying to do is make stuff that's complex simple from an investment standpoint. That's the entire nature of it.
And you do an amazing job. Video number 2 is going to be the Fed pivot. We just talked about the yield inversions calling for it. So we're going to talk about Fed pivot number 2. Thanks, buddy.
Let's do it.